Today I want to have a look at three companies which are near their 52-week lows and have a great growth potential into the second half of the year. And the first company we will have a look at is Nike. So we will jump over to my fully automatic stock valuation spreadsheet and plug in Nike's ticker NKE, and we will wait for the metrics to show up. And looking to the right here, we can see that it does pay out a very sweet dividend of 1.61% with a dividend payout of $1.48 and a very nice free cash flow payout ratio of just below 40%. Now this dividend wouldn't look so great at all if we haven't looked at Nike's dividend history graph. From it, we can see that since 2014, the company has increased their amounts in dividends from $0.12 all the way up to $0.37 in 2024, which is more than a 200% increase within the last 10 years, making Nike a great dividend growth company for that sweet snowball effect. Now jumping to the 9-pillar analysis, we can see that 2 of the 9 pillars are sitting in the red, and those are the 5-year PE ratio and the price to free cash flow over the past 5 years. We generally like these two to be sitting below 22.5 or below 20 for the price to free cash flow. Now, as Nike is a well-established company that should be trading at a premium, I'm quite fine with these two metrics being in the red. And it looks like Nike has been increasing their revenue and their free cash flow as well as their net income over the past 5 years at very decent rates. As well, their 5-year profit margin is sitting at a very healthy percentage of 44.5%. And if we scroll down, we can see that indeed it has been sitting at that level over the past 5 years. Now moving further down, we can see that the P ratio of the company is decreasing, which is always a good sign. We can see that the revenue and net income are both increasing and that the shares outstanding are decreasing slightly, which is great as it means that you will own a larger percentage of the company with time. We can also see that the free cash flow is increasing and that the quarterly dividend is increasing very nicely as well. Now, something I always watch out for when evaluating a company is the free cash flow, long-term liabilities, and the quarterly dividend. If I see the quarterly dividend and the long-term liabilities both increasing, I want to see a good increase in free cash flow, as I want the company to generate enough free cash flow to cover all their long-term liabilities, negative dividends. So essentially, we want this metric to be sitting below 3. We can see that Nike's is currently sitting just slightly above 1, which means that the company can pay off all their long-term liabilities within 5 years or so. Now let's calculate Nike's intrinsic value. And first, let's jump to the Grams formula. We'll take the Grams formula, the trending earnings per share, base PE 5-year growth estimate, and get an intrinsic value of $76.47, which is actually slightly lower than the current trading price by about 20%. And just a quick reminder, if you do enjoy these valuation sheets and like to download them for yourself for your personal use, you can do so at my Patreon in the link in the description. Now moving to our next valuation model, the discounted cash flow model, we take the free cash flow over the past 5 years and calculate the average growth rate to be setting at 60%. Now this large percentage growth rate is calculated due to the large drop in free cash flow in 2020. So looking at these metrics, we can see that the average growth would be sitting at about 4%. And looking at the analyst projected growth, we can calculate a growth percentage of about 4.2% over the next 10 years every single year. And using this, we'll calculate the future free cash flow, and then plugging in the discount rate at 8%, we'll calculate the present value of that future free cash flow, and we'll get an intrinsic value of $84.25, slightly lower than the current trading price. Now moving to our next valuation model, the multiples valuation model, we will compare Nike to DEC and SKX. We'll take these company stock prices and divide by their earnings per share to get their PE ratios. We'll average them out and multiply by the earnings per share of Nike to get an intrinsic value of $93.71, slightly higher than the current trading price of Nike, showing that it might be slightly undervalued compared to its competitors based on its earnings per share. Now our final model is the dividend discount model, and here we will figure out Nike's dividend and Nike's future dividend and compare it to its current trading price to figure out its intrinsic value. So we will figure out the average growth rate to be sitting at about 11.21%, and if we have a look at the 9 pillars, we can see that the dividends have been increasing fairly well over the past 5 years at a very steady rate. So going back to our dividend discount model, I will plug in a projected growth rate of 11% into the future and plug in a yearly dividend frequency of 4. Now the issue with the dividend discount model is that when the WACC is lower than the projected growth rate, the intrinsic value comes out negative. And therefore I have my alternative dividend discount model where I will plug in the next year's dividend and the WACC of the company and the stock price next year and calculate an intrinsic value of $109.37. Now jumping to our ultimate valuation, we average out the 4 valuations models we just did and get an intrinsic value of $90.95, slightly lower than the current trading price actually. Now plugging in a margin of safety of 10%, we would get an acceptable buy price at $81.85. I do think that Nike's value is higher than the intrinsic value we just calculated here, and that it is a great stock to keep a lookout for into Q3 of 2024. But now let's move to the second company of the video, which will be Coca-Cola. So we will plug in the ticker KO and wait for the metrics to show up. And right away we can see that over the past 5,000 days, the company has been going up very steadily. And looking over to the right, we can see that its dividend yield is sitting at 3.13, almost 100% higher than Nike's dividend yield, giving us a dividend payout of almost $2 per share per year, with quite a high free cash flow trailing payout ratio at almost 75%. Now let's check out if this will be an issue for us. So let's move to the 9-pill analysis and have a look at the long-term liabilities, which is sitting slightly above what we want to see, sitting at 3.78. But let's scroll a bit down and find the free cash flow, quarterly dividend, and long-term liabilities. We can see that the free cash flow has been increasing slightly, the quarterly dividend has been increasing slightly as well, and the long-term liabilities have been increasing very slightly as well. Now the free cash flow is sitting at a very high value and increasing at a rate that it can cover all the long-term liabilities. But with the quarterly dividend increasing and the shares outstanding increasing as well, and the free cash flow payout ratio being quite high, I would generally look out for this metric. Now in this case I don't really have an issue with the long-term liabilities being slightly higher than 3, as Coca-Cola is a well-established company and they cannot really push their free cash flow into anything else than buying back shares or paying out a dividend. Now other than that, we can see that they have consecutive dividend growth, net income growth, revenue growth, and increasing free cash flow, with slightly increasing shares outstanding, which I don't really like with any company, but it certainly isn't a deal breaker. Now let's move to calculating the intrinsic value. So we will use the Grams formula again. We will take the earnings per share, the trailing earnings per share over the past 5 years, the base PE, the 5-year growth estimate, the growth rate multiplier, the average yield on A corporation bonds, and divide everything by the short-term average yield on A corporation bonds to get an intrinsic value of $46.04, 35% lower than the current trading price, hinting towards the fact that Coca-Cola's trailing earnings per share is slower than what we are paying for. But if we jump back to 9-pill analysis, we can see that the earnings per share of Coca-Cola is actually going up quite well. Now let's jump to the next valuation model, the discounted cash flow model, and here again we will take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 2.34%. The analysts do project a growth rate of 4.67%. I will project a growth rate of just about 3% to be conservative and calculate the future free cash flow. I will then plug in a discount rate at 6%, as I don't really need that high of a return with Coca-Cola, and I will get an intrinsic value of $62.63, very slightly higher than the current trading price of the company by only 63 cents. Now, moving to the multiples valuation, here we have to pick out the companies we will compare Coca-Cola to. And I want to compare Coca-Cola to Pepsi, so PEP, and Monster Beverage, that is MNST. So I will plug these two in and I will delete SKX and we'll get an intrinsic value of $74.64, which is quite higher than the current trading price, showing us that Coca-Cola is undervalued compared to companies which operate in the same sector, specifically Pepsi Cola and Monster, probably its biggest competitors. Now moving to the final model, the dividend discount model, we will calculate the average growth rate to be sitting at 4.21% using the 5-year historical data. Now, as I like to be conservative, I will plug in a projected growth rate of 3.5%, and plugging that in, we'll get an intrinsic value of $84.85. Now moving to our ultimate valuation model, we will switch the alternative dividend discount model to the dividend discount valuation, and averaging out those four valuations, we'll get an intrinsic value of $67.04, 8.13% higher than the current trading price. Now, if we plug in a margin of safety of 10%, we would get an acceptable buy price at $60.34. To be fully transparent, I did buy into Coca-Cola about 2 months ago when it was trading at around $58 per share, so I did see some return on that during the past 2 months. And now for the next and final company I want to have a look at today, TROW price. And to evaluate this company, we will have to jump to my financial stock valuations as it is a financial stock. So I have already plugged in the ticker TROW, and we can see the dividends of the company right away. We can see that from the 3 companies we are evaluating today, TROW's dividend yield is sitting at the highest place, sitting at 4.20% with a dividend payout of just below $5 per share per year and a trailing free cash flow payout ratio just below 60%, which isn't that bad. Now let's have a look at the 9-pillar analysis. And here we can see that the 9 pillars are slightly different with one main change, and that is the price to tangible book value. For TROW, we have a price to tangible book value sitting at 4.15, which would mean that the company is very much overvalued compared to the tangible assets they have. But other than that, we can see everything is in the green. We can see that the company is buying back shares. We can see that their 5-year PE ratio and that their price to free cash flow are both sitting at very nice values, and that they have been increasing their revenue growth, their free cash flow, and their net income, as well as their total liabilities over the 5-year free cash flow negative dividends is sitting at 0.53 with a consecutive dividend growth of 15.20% over the past 5 years. So internally overall, we can see that the company is doing very well. But now let's jump to calculating its intrinsic value. First using the Graham's formula revised. And we can see that when we apply the formula up here, we'll get an intrinsic value of $90 per share, which is actually 31% lower than the current trading price of the company. Now let's jump to the next valuation model, which is the price to tangible book value. Here we will compare the current price to tangible book value of TROW to its historical price to tangible book value, and if its present tangible book value is lower than its historical one, we get an intrinsic value that is higher than the current trading price. So we will take the historical price per share, the historical equity value, negative intangible assets, and the historical shares outstanding, and calculate our historical price to tangible book value. We will then look at the present value, and using that, we'll get our intrinsic value to be sitting at $131.35, higher than the current trading price. Now moving to the multiples valuation, and here I want to compare TROW to OWL and STT, companies which operate in the same sector. And this is slightly different to the multiples valuation we did before. Here we will take the stock price of the companies and their book values per share and calculate the price to book value of the 2 companies. We'll then average out the price to book value companies, and similarly to our tangible book value model, we will calculate the intrinsic value to be sitting at $141.41, hinting towards the fact that TROW is undervalued compared to its peers. Now moving to our final valuation model, the dividend discount model, and here we'll take the dividend payout over the past 5 years and calculate the average growth rate to be sitting at 4.55%. Now, as I like to be conservative, I will project a growth rate of 9% every single year, and using that, I will get an intrinsic value of $134.07. And now moving to our final valuation, we'll switch the models to the dividend discount valuation, and averaging out the 4 valuations we did prior, we'll get an intrinsic value of $124.21, 5% higher than the current trading price. So if we plug in a margin of safety of say 15%, we would get an acceptable buy price of $105.58. Now I highly recommend you to keep an eye on these 3 companies into the next half of 2024. And with that, if you did enjoy these valuation sheets, make sure to check them out at my Patreon in the link in the description and let me know which company you'd like me to evaluate next.